This is a presentation in supplement to our project in Managerial Accounting. Our virtual company name is called G7. Our team members have experience in marketing, sales and production of electronics which destined to the type of our product. The product chosen is simple but widespread on the market. It is temperature measurement sensor, which is mandatory supplemental equipment to the modern heat management systems. The producer of the systems are actually purchasing those sensors from third parties. We've used a reliable marketing data from research performed in 2014, which shows the growing demand for heat management systems in the Balkan region. This demand is estimated to be over 1 million units in 2016. Each heat management system is using at least one temperature measurement sensor and in some cases up to 4. Therefore, our conclusion is that the demand of such sensors would be way over 1 million. Our goal is market penetration and gain of 10% market share during the first year of operation, which further to increase with 20% per year. During the product research, we found that the market price of those products is significantly higher than the direct material cost, calculated at 1.04 euro. The prices found were from 12 euro the cheapest to 40 euro the most expensive. Here is one example from eBay price of 33 euro per unit. These findings have encouraged us to further examine the process of development, effective production and release of such products aiming low cost with relatively low investment into sales force and logistic operations. We plan to start our business operations in January 2016. End of year 2015, we shall rent or settle a production facility. The raw material will be supplied by Chinese companies and is negotiated at very competitive wholesale prices DGP. Next thing to do is to organize production structure and related processes employing the theories, knowledge, practices and tools of the financial and management accounting in order to perform efficiently and get a competitive advantage of our product. The complete operation planning of the production activities would be performed by the company manager at first. For the first year of production, 4 production workers will be employed. Other services as accounting, bookkeeping and marketing would be outsourced. The production process is explicitly labor-intensive and does not involve machinery. It is one of our major contributors to the low-cost competitive advantage known as low cost of labor in Bulgaria. We shall employ 2 sales representatives, which would be enough considering the target for B2B wholesale. Investment consists of only 2 vehicles and 1 small truck to serve deliveries to customers and deliveries to some raw materials for the production. As already reviewed in the marketing research, the set target for year 2016 is production sale of 100,000 units. After receiving the offers from the suppliers, the direct materials is calculated at 1.04 euro per unit. The base for calculation of the direct labor involved is a salary of 250 euro per month for production worker, and the result is 15 cents per unit. Needed to meet the target in 2016 are 4 production workers. Our overheads are calculated to 65,000 euro per year and including rent of small production hall, indirect administrative materials, salaries of management and 1 office assistant, utility as electricity and water, and so on. The overhead per hour came to 4.80 euro per labor hour and 65 cents per unit of production. The cost of direct labor and direct material summed up to €1.85 per unit. Since several similar products are found in the market prices between 13 and €31, we felt very confident to add up 30% markup to our cost and to set a selling price of €2.40. In this way, our product cost structure would look like this: 50% variable cost, 27% fixed cost, 23% markup. A target of production and sales of 100,000 units, the break-even analysis shows a point of nearly 45,000 units. This gave us a very good safety margin of 46,000 units. The company has relatively low operating leverage at 35%, as most of the costs are variable and they incur only when there is production and sale. The firm earns more profit on each incremental sale, but doesn't have to generate much sales volume to cover its fixed costs. This in our case seems good as we are a startup company and we can earn profit even at low sales levels while keep the costs under control. The strategy of G7 as startup company is to minimize the fixed cost. Some services are outsourced, as with the use bookkeeping and marketing agencies instead own units. The capital investments are considered and optimized. Depreciation is in relatively small ratio to the operating expenses. With sales of 100,000 units, all costs are covered and profit is generated. Here is an overview of our master budget for the first year. Payments from the customers are disbursed in 60-40 ratio for the present and the following month, and this postponed obligation is an advantage by potential customers and their cash budget. Production budget slightly increases due to the desired build-up of antique inventory, ensuring stock availability by ratio of 20% and 15% for available inventory for production materials. Payments to the suppliers are negotiated to be 80% in the present period and 20% in the one following. Bank loan of €100,000 is negotiated. Average of €50,000 in cash would bring all related advantages and comfort in operation. The 5-year budget forecasts doubling the sales at the end of the period. The loan is covered and the company is reaching cash. Though, however, the doubled sales, the resulting net operating income is increased with only 30% at the end of the period, due to the low operating leverage of the company. Couple of pessimistic scenarios are employed in what-if analysis. The first one: what would happen with the net operating income if the sales are at only 50% of the forecast? And the answer: G7 would generate operating loss during first year of operations and low profit in the first year to follow. However, profit is there and it is not required additional investments or borrowings, as the fixed costs are covered and the company would much easier concentrate, for example, over marketing activities to bring the sale to the desired level. The second scenario is: if the production employees can be hired at the forecasted low rate and can only be hired at rates double than prediction, €500 instead of €250 per month per worker, and the sales are still at half rate of the forecasted ones. And the result is: sales are in half, the production employees cost double, G7 is generating loss in the first year of operation, nearly break even at the second one, and low profit in the periods following. But in a 4-year period, the profits would cover the initial loss, and this is an advantage for the given period, as even if the company would not generate profit, it would stay operational and cover its costs. The highly positive NPV value points that the investment proposal is very attractive. High internal rate of return is also high, quite exceeds the assessed risk of the project. Payback period shows that period for to recover the investment made is less than 2 years. G7 developed a corresponding product answering the demand and well-settled criteria as technically simple and easy for mass production, competitive price including reasonable markup, low initial investment, good rates of return and profitability. Suppliers of raw materials at reasonable prices were contracted, ensuring a low price of the direct materials. Precise production cycle planning and calculations of the needed workforce were performed with targets to keep effective and low the direct labor costs. The production process is strongly labor-intensive, which combined with the low rates of the workforce in Bulgaria gives strong competitive advantage for the company and its products. The company shows potential for profit generation and sharing or considerable dividend paid depending on the type of investment made. The analysis confirms that the business plan is attractive and the investment proposal should be accepted. I hope you enjoyed the presentation and now you are our future loyal investor in our product.